Thank you all for attending. I'm Dar-Lon Chang, and I worked at ExxonMobil Upstream Research Company from 2003 until 2019. My last day there, I was wearing this shirt. It's colored green, the color of money that controlled my research career there. But it's also the color of leaves on trees, and I was leaving because of three major splinters that were on my mind. And the three major splinters were this. The first splinter is that the fossil fuels that the world depends on is becoming dangerously limited. And over the 16 years I worked at ExxonMobil, almost half of it had a pretty flat oil production rate. There's a saying that money doesn't grow on trees, and that leaves the impression that money is more precious than trees. But we need that money to pay for the fossil fuel that we certainly don't grow on trees. Oil, natural gas, and coal. They all come from the processes that happened hundreds of millions of years ago, where ancient plants were buried, cooked underground, and trapped in places where people could find them, drill holes to get to them, and bring them to the surface to process them into the fossil fuels that run our machines, our trucks, our planes, and our cars today. Over about 170 years, civilization released sunlight energy that was collected over millions of years of ancient plant growth. But like releasing the tomb of the pharaoh, we also released a curse when we burned these fossil fuels, and that was the millions of years of carbon dioxide that had been trapped underground that is now in our atmosphere. So having unwittingly released this, we have the second splinter on my mind, drastic climate consequences. So scientists are telling us that there are tipping points that we're in danger of breaching. If we get average atmospheric temperatures above 1.5 degrees C over what it was before 1850, then we risk corn crops being reduced by 10% globally. Even worse, if we get to 3 degrees C, scientists don't even bother to quantify it. They just say there will be drastic reductions in corn crops globally. And knowing how much my daughter loves to eat corn products, that would be very bad for her. Finally, the third splinter on my mind that keeps us from doing anything about the first two splinters is debt. A massive amount of money was borrowed in order to get this oil production. And that money was borrowed and essentially locked in reckless decisions. The shape of world debt shown here drives the shape of oil production over here. And even worse, the debt has to be repaid with interest. So in order for that interest to be paid, we have to increase world oil production. So I'm going to focus first on the evidence for the first splinter, the dangerous limits on world oil production and fossil fuels in general. So the black line here is the price of crude oil. When I started in 2003, crude oil was around $30 a barrel. And in my first 2 years at ExxonMobil, it increased from $30 to $50. And along with that, our oil production increased from about 68 to about 74 million barrels per day. But oil production stayed flat for about 7 years, all the way until about 2011. And during those 7 years, oil prices did not stay flat. They fluctuated wildly, going from $50 in 2007 to $150 in 2008, the year of the global financial crisis. Because of the financial crisis, companies weren't able to borrow enough money in order to get the oil they needed, and the oil prices dropped to $40 a barrel the following year in 2009. But it only took 2 years of stimulus spending where governments around the world tried to get companies to build anything, build roads, build empty cities that nobody lives in, and they managed to get the oil price up to around $100 a barrel, and it stayed there for about 4 years. And with this high oil price for over 4 years, they finally were able to get that oil production to budge from about 74 to 78 million barrels per day. And the main driver behind this was US shale oil, this yellow wedge here. I'm going to talk about US shale oil and why it's not good as the old oil that we used to have, but it took a tremendous amount of money and high oil prices in order to get it. Unfortunately for the shale oil industry, oil prices dropped from $100 a barrel to between $30 and $60 a barrel over the next 4 years. And despite this, shale oil still had to increase and still had to produce more in order to pay off all the loans that they borrowed in order to get that slight bump in oil production. Now, in the chart on the right, what I show here is essentially the same oil production plot, except it's split between conventional oil in gold and unconventional oil in blue. Now, conventional oil is where you drill a hole straight down into the ground, you put in some pipes to make a well, and then you use the natural weight of the earth to push the oil that's trapped in the pores of the rock up into the well and up to the surface, where you have a surface facility to process it into the fossil fuels that you're going to sell. Unconventional oil needs a lot more work than that. It needs a lot more investment. An example of unconventional oil is where the rock is too tight, the pore throats are too tight to allow the oil to flow up naturally. So you have to inject high pressure liquid underground and hydraulically fracture the rock, making cracks so that the pores can connect to each other and that you can get the oil to come up. Another unconventional oil would be where the oil is like peanut butter in the ground. It doesn't flow like liquid, so you have to inject steam underground and cook it underground so that it can actually flow up to the surface as liquid. And finally, another unconventional oil is where the oil is underneath the ocean, where you have to get expensive ships out into the ocean and you have to drill thousands of feet under the bottom of the ocean in order to get to the oil. So all these things require a lot more money, a lot more loans, a lot more debt in order to get than conventional oil. But even worse than that is that you get less net energy out of unconventional oil. You can see in this plot that conventional oil has been pretty flat over the last 16 years, but unconventional oil has been increasing. And we're relying more and more on unconventional oil. In order to explain this net energy concept, suppose that I have a conventional job where I make $100 a day. And in order to get to that job, I have to have a car to commute to the job. And I have to pay $10 a day for the car expenses, for the gasoline, for the insurance, for the car payments. That would be like the energy input you need for conventional energy. So out of that $100 a day, I have to spend $10 a day on my car. And I get $90 a day that I can use to pay my bills and to pay my debts. Now, with a conventional car, I can expect that car to last about 20 years before it breaks down and I need to get major repairs. But suppose that I go to buy a conventional car and they're sold out, and all that I can buy is an unconventional car. And this unconventional car, rather than lasting 20 years, only lasts about 2 before I have to pay for major repairs. And because of that, my payments are more like $20 a month, $20 a day rather than $10 a day, so that I only have $80 a day to spend. Well, I had $90 in expenses, so where am I going to get that extra $10? I either cut back on my quality of life, or I borrow that $10 a day, and I expect my daughter to pay back that debt later on. So suppose that that's not just me, but that's world civilization. And suppose that that's not just net income, that's net energy. We're creating a net energy debt that we're expecting to be paid back later on by future generations. But in addition to that, we're creating a net carbon debt that is going to lead to drastic climate consequences. Now, my daughter, she's 11 years old, she experienced these climate consequences 2 years ago during Hurricane Harvey. Hurricane Harvey came onto the shores of southeast Texas, and Houston was majorly affected. Many areas were flooded, and we had to evacuate. We were lucky we evacuated early because 2 days later, when mandatory evacuations were finally in effect, people couldn't get out. Their streets were flooded, and they had to be rescued by boat. So we were actually the lucky ones. But we saw the consequences of Hurricane Harvey. Many homes were flooded, many cars were totaled. And it turned out that Hurricane Harvey rivals Hurricane Katrina for being the costliest US Atlantic hurricane. In the same year as Hurricane Harvey in 2017, there were 2 other hurricanes that are in the top 5. There's Hurricane Maria that hit Puerto Rico, and there's Hurricane Irma that hit Florida. And number 6 is actually Hurricane Ike, which my daughter doesn't remember because she was 2 months old at the time. But we were stranded in our home without power and without running water for 4 days because of Hurricane Ike. So besides the consequences of hurricanes, there's many worse consequences that are on the horizon. Scientists predict that we could be looking at Arctic sea ice tipping points, we could be looking at rainforests, we could be looking at agricultural systems leading to tipping points. And as I mentioned before, 1.5 degrees will be a tipping point where corn crops will be reduced by about 10%. According to scientists' forecasts, my daughter, when she's an adult in her 30s, she might see these corn crop reductions by 10%. The reason is that in this plot, you can see where we are at 1 degree C above 1850 levels. Right now, that 1 degree C represents our current state, and the 1.5 degrees C where we start to have crop reductions is shown here. It's only about 20 years before we get to 1.5 degrees C if we don't do anything to reduce our increasing emissions per year. Despite all of the efforts made over the last 30 years to reduce emissions, we still have had increasing emissions all the way until now. Well, scientists say that we have to stop the increases in emissions and we have to decrease them in order to have a chance to be able to avert these worst consequences. But what does that mean on a personal level? Well, my daughter isn't too many years away from me considering buying a car. Let's say I decide to buy a car that doesn't have working brakes and doesn't have seat belts and doesn't have an airbag. That would be what would happen if we let carbon emissions continue to rise as they have in the past. Now, what if I love her enough that I want to give her a car that at least has working brakes, Well, scientists say in order for her to have working brakes, we would have to stop the rise in carbon emissions per year, and we would have to reduce it by 30% over the next 10 years and get it down to 0 by 2055. Now, what if I love her enough that not only do I want working brakes, I also want her to have seat belts? If I want her to have seat belts, then we need to reduce emissions by half in 10 years, and we need to get it down to 0 by 2040. And what if I wanted her to have airbags too? Well, now I'm really spoiling her. I want her to have a car that's as good as the car that I have right now. But in order to do that, we'd have to drastically reduce emissions not only from carbon dioxide, but greenhouse gases that are not carbon dioxide. This is what the scientists are telling us. And these are the consequences that we're looking at if we don't take drastic action to avert these consequences. So why is it so hard to address these first two splinters? The reason is debt. Money doesn't grow on trees, but it can be borrowed, and it has been borrowed in large amounts. In fact, it's been borrowed so much that money is essentially debt. Money comes from borrowing. So in order to get that unconventional energy that I showed you before, this is the debt that was collected from 2016 until 2022 by energy companies that are considered to be risky debt. These are energy companies that are focused on unconventionals, and the debt is projected to increase from $20 billion in 2016 to more than 14 times $280 billion by 2022. Now, this tremendous amount of debt to get that unconventional oil, it's part of this world debt that we're looking at. And you can see that much of the debt is coming from the red, which is developing countries, whereas in the blue, the developed countries like the US, it's pretty flat. This might remind you of something. This looks a lot like conventional versus unconventional oil. In order to get that unconventional oil, you need a lot of debt. Now, what about my own company? What does ExxonMobil feel about this? Well, ExxonMobil, their energy outlook for 2019 says that we are going to flatten our carbon dioxide emissions from 2020 to 2040. But we're still going to need more oil in order to supply all of this emerging economy debt. Now, the emerging economy debt, it's expected by ExxonMobil that we're going to double our income, which is world GDP, from 2020 to 2040. So somehow we're going to double our income, and we're going to increase our debt to a similar amount, but we're also going to use that debt to fill this wedge. This green shows what would happen if there was no debt and if there's no investment to be able to get more oil. And this gap between this solid line and this green wedge is the amount of debt that would be needed to be able to get this extra oil, this oil supply that's supposed to increase from ExxonMobil's perspective. Now, how they think that we can increase our oil production and burning of oil while also keeping our carbon dioxide emissions flat is beyond me. But if you assume that that could be done, that's still not anywhere close to getting my daughter a car with seat belts, working brakes, and an airbag. In order to do that, we have to reduce it to 0 by 2040, versus by 2040, ExxonMobil says we're going to keep the carbon dioxide emissions flat. So if we don't work together to make our voices heard and to emphasize what we really value, which is our kids and our future generations, we're going to allow debt to make the decisions for us. So instead of my daughter remembering Hurricane Harvey as the biggest memory of her childhood, I wanted her to remember a protest. So if she heard that I was going to get her a car without working brakes, without a seatbelt, and without airbags, I would want her to protest. And that's exactly what kids around the world are doing right now. They're protesting that the previous generations are giving them a car that's going to crash. And we did go to the September 20th Friday protest, and I hope that that gave my daughter a good memory. When Greta Thunberg came, unfortunately it was too last minute, so I couldn't bring my daughter along, and I had to go by myself. But it gave me a lot of heart to see that on the bus, nearly half the bus was going to that event as well. And they were all talking about how they felt that this was a historical moment. So I wore this green shirt when I was volunteering for the Green Homes Tour. That was a few weeks ago. In my community that I moved to after leaving ExxonMobil. I now live in the GEOS community, which is a community dedicated to net zero energy houses and sustainable living. We're a decarbonized community, and we were a popular stop on this tour. So I wear this green shirt now for this presentation, and it's because I'm here to speak for the trees, because we need to leave fossil fuels in the ground.
Thank you. That was a perfect segue for what I'm going to talk about. But I'm really excited to follow your presentation because I think I'm going to be focusing on the divestment movement, which is really about moving our money out of fossil fuels and into renewable energy or other places. So, and I want to, before I start, I want to ask how many folks are PERA members. There might just be, okay, good. And I just wanted to mention that I think everything that I'm going to share, while I'll be talking about it in the context of PERA, I think that it is relevant for wherever your money is invested. So as you're hearing from both Dan and myself, just keep that in mind. It's not just about pension funds, but it's actually every layer of our financial system is investing in fossil fuels and propping up this system, and we need to change it. So I'm excited to share a little bit about the campaigns that we're working on at 350 Colorado. So I'll start there. I'll just start by introducing myself. So I'm Deb McNamara, and I'm the campaign coordinator with 350 Colorado. And we are entirely focused on climate solutions. We're a grassroots organization. We're a nonprofit. There are actually only 4 of us on staff, but we have hundreds, actually probably thousands of volunteers around the state working on all kinds of campaigns, divestment, promoting renewable energy, advancing public banking, protecting public lands and stopping oil and gas development on public lands, stopping fracking in the state. Anyway, there's a long list, but I just wanted to give you all an idea of some of the things that we're working on. And I won't go too far into these questions, but as somebody that's working on campaigns focused on where we're investing our money, one of the questions that we're always thinking about is what does fiduciary duty look like in this new era that you so perfectly laid out for us. So we have these, we have an imminent crisis, and we have these deadlines that we're being given by scientists, and so we need to change not only how the money is propping up our system, but also where we're investing and how we're extracting, what kind of energy we're using. So what does fiduciary duty look like in this new urgent era of climate risk? So, and again, you can hold this question not only about your pension fund if you have one, but anywhere that you're investing. So right now, and actually a couple of us, I know Marie Venner and I were just at a meeting with the leaders, the director and the chief investment officer of PERA a couple weeks ago, and they're telling us, well, we have to keep our investments where they are because of fiduciary duty. We're still meeting our benchmarks with our coal investments and our oil and gas investments. And I think that's like the mind shift that we're in right now, is we need to look differently at that. It's like, okay, well, maybe for this short term, but long term, what does this look like? And particularly for people's pension funds, we're talking, a lot of the people that I work with in the fossil-free PERA campaign, which I'll speak to, are worried about what their retirement's gonna look like in the year 2030 or 2040 or 2050, when we know some of these potential crises and these negative indicators are going to be coming to the fore. So another question is just around assessing investment risks and the projected losses around the likelihood of stranded assets. So as things, and Dan will talk about stranded assets a bit more too, but as we continue to shift as a society, we can't monetize these fossil fuels that need to stay in the ground, right? So what is that, how is that going to impact our financial system, our pensions, our investments, and so on? I want to just read this quote, and I think, again, it kind of reaffirms what you were just sharing, but, and this came from the Wall Street Journal, but there's consensus within the scientific community that increasing the global temperature by more than 2 degrees Celsius will likely cause devastating and irreversible damage to the planet. At least 2/3 of fossil fuel reserves will not be monetized if we're going to stay below 2 degrees of warming, and that's what's going to create these stranded assets. So it just depends on, what kind of future we want to be envisioning and looking forward to. So if we want to stay in this range, and I know you were mentioning 1.5 degrees, which I know at 350 Colorado, we definitely want to keep that as the benchmark that we're working towards. But I know at 2 degrees Celsius, that's when a lot of the species extinction rates are said to be really to bump up. So it's like at every bit that the temperature warms, there are new threats, and so we're talking about 2 degrees here, but that's, that would be catastrophic, actually. We really need to keep it more at that 1.5 degree level. So I just wanted to share a couple of things about why divestment and this moving of money out of fossil fuels and into renewable energy, ideally, or other places is so important, and how it is negatively affecting not only pension funds, but anyone's investments. So a couple of trends. So the energy sector was solidly in last place in the S&P 500 in 2018, and a lot of people don't know this. So I just wanted to share, kind of what some of these trends are and how fossil fuels are performing in the market. And in 2017, the energy sector was in the second to last place. So some other things that we're paying attention to in the divestment movement, and I'll say more about the divestment movement, but this is a global movement with a lot of momentum. And these are some of the trends that we're really paying attention to. So, and again, it's perfect to go after your presentation, just some of these things that are happening. So the profits have dropped, the cash flow's down, the debt loads are rising, which you spoke to so perfectly. The growth opportunities are limited. It's getting harder and harder to extract, and it's costing more and more money to extract. The investment risks are mounting, and I just mentioned a couple other things here, but there's also this litigation risk. And I think the timing of our presentations is interesting because of the Exxon lawsuit coming to the fore. I think that is about to happen next week. right? Is that, yeah. So, and I think that lawsuit around, focused on Exxon is a perfect example of these litigation risks that I think we're going to see them increasing. And I haven't looked in a couple of months, but a few months ago when I looked, there were at least like 600 or maybe closer to 1,000 lawsuits focused on the fossil fuel industry around this issue of climate denial. And you knew, and yet you're still going forward with, as if there are no consequences. So I think the litigation risk is something that we're going to be seeing more or hearing more about that. So I wanted to include a bit about Exxon in light of tonight's theme. So in the 80s, fossil fuel stocks accounted for 7 of the top 10 companies in the S&P 500, and today, at least again when I initially did this research, Exxon was the only one. And so I think that's, again, just kind of showing us like how things are shifting. And then Exxon shares have been in decline for at least 5 years, delivering a total return of around 1% annually. So one might ask, and I see your hand down, let me finish my sentence and then I'll call on you. One might ask, like, why would we want to still be having our investments in Exxon? And I did pull up some numbers about PERA. So PERA has, as of October 16th, so what is that, a week ago, $166 million invested in Exxon stocks. So again, it's kind of like, why? Given these trends, why are we still putting our money here? And Dan, did you want to clarify?
I just had to mention that
Yeah.
this has just happened, but as of 2, maybe 3 weeks ago, Exxon has now dropped out of that top 10 for the first
okay.
since the S&P 500 was created.
Okay, thank you. Yeah.
Now we have 0 energy companies
In that top 10.
Yeah,
Thank you. Yeah, and I was wondering, I know that's why I said when I looked into this a little bit ago, it was like number 7 or something like that. So yeah, so again, like, why are we continuing to make these decisions? So another thing to mention, and Dan will talk about this too, but over the last 3 and 5 years, respectively, global stock indexes without fossil fuel holdings have outperformed identical ones with fossil fuel companies. So it's becoming increasingly, the argument against fossil-free investments is becoming increasingly less relevant as time goes on, and Dan will say a little bit more about that too. I thought it'd be, I won't say too much about it, but I think coal is a good example of just like this trend that we can expect other fossil fuels to follow. And again, I pulled out some numbers about PERA. So this was in 2017, but it looked like PERA had over $600 million invested in coal exit companies. And those are companies that are building new coal plants or mines. And that's about 153 companies that PERA was invested in 2017. Now, I'm still trying to figure out more updated numbers, but just to give you a sense that, again, like, why are we doing that when we see the trajectory that coal has been taking for a long time, and it hasn't been shifting, and yet we're still investing here.
Could I ask you a question?
Are questions okay? I think so. Is that all right, Martin? Yeah, go ahead. Yeah.
You had said that you talked to the PERA staff, and they said that they needed to stay in oil and gas because of the returns that they're presumably getting. And yet your data is saying that the returns aren't there, or at the 1% or whatever.
Right.
Perhaps worse.
Yeah.
So if the returns are that bad, are their PERA stockholders happy with a 1% return?
Repeat the question.
Oh, I'm sorry. Well, I think you're asking about why, if the benchmarks are being met, but there are also these declining returns. I think there's just some discrepancy about that. I know in other parts of the world, coal is still performing, like globally, coal is still performing better in India and China, for example. So I think they're focusing on how coal is performing in other markets, even though here in the U.S. there's a massive wave of bankruptcies. So so it's kind of like in one place it might look like this, but in another place it still has some bit of strength left, even though incidentally in India and China, where coal is still performing well, renewables are actually performing better than coal, just again to kind of if you're paying attention to these trends, there is that story that coal is still going gangbusters to, in a certain way, but the renewable energy sector is creeping up and about to take over too. So again, and this is just in the US, but coal production fell to a 40-year low this year. And then statistics are showing in the next 35 years, the industry can expect to see annual returns reduced by 26 to 82%. Similar numbers with oil and utilities, falling by 38 to 60%. So again, just wanted to share some of these trends. And Dan's going to say a little bit more about this too, just about the levelized cost of energy right now. But we just recently passed this milestone where coal is more expensive, and prices per megawatt hour from electricity for coal power plants were ranging from $60 to $143, and then wind is now significantly cheaper, from $29 to $56. So that's really exciting that we have, that we're in the midst of this transition where renewables are becoming, if not are already, less expensive. Okay, so I'll just say a couple more things about divestment in general and why we think in the climate movement that this is such an important part of the solution. So I think based on a lot of what you've been hearing, you hopefully agree that the likelihood of returns from the fossil fuel sector won't replicate past performance. I think the likelihood of that is high, especially if we feel optimistic that we might make these changes that we need to make. So we think that it's a really important place to focus some energy and attention, is this moving money out of fossil fuels and helping to reinvest in the future that we want to create. I don't know if you all can see the text here, but I'll just say a couple things about the types of institutions divesting. So faith-based institutions are leading in this sphere, so 29%, and these numbers are from 2018. But 29% of the organizations focused on divestment right now are faith-based, and then you've got philanthropic, educational, government. Pension funds account for about 15% of those that have already committed to divestment, and then some other smaller organizations that aren't listed there. I think it's really exciting how fast this movement has caught on. So there are over 1,100 known institutions that have made this decision, and now the dollar amount is $11.5 trillion that has been committed to divestment. And just to give you a sense of how fast that has happened, in 2014, there was just about $52 billion that had been committed to move out of fossil fuels. And now, as I said, 11.5 trillion is the current number, and that's an increase of 22,000%. So again, I, as a climate activist, and I'm someone that's been working in the environmental nonprofit field for almost 20 years, I find this really exciting, that it is showing that this understanding is hopefully growing, and that people realize that this doesn't make sense. And again, this is just a bit about pension funds, but last year, New York State, New York City, and London were calling on pension funds to divest. French and Australian pension funds have moved to divest. The World Bank has ended its lending to fossil fuel projects, and then Ireland was the first country to divest. That was last year. And I like this graph. Again, this was from 2018, but again, just kind of shows this upward trend. And again, this is just because I know we were focusing on pension funds, and I'm glad to see that so many of you are PERA members, but the UN Secretary General has advised pension funds to divest, and according to a 2018 report, and that's where some of these stats and graphs came from, 61 pension funds worldwide had committed to divesting since 2016, so just in the last couple of years. And that number was, a few months ago, was 144 pension funds, so I'm sure it's higher now. But again, here in Colorado, and this is part of when Marie and I met with, we had about 10 of us that met with the PERA folks a few weeks ago. That was our question. Well, we know that so many pension funds are making this choice. Like, why isn't PERA moving on this more quickly and more urgently? I just have a couple more slides here, but this just shows you 37 countries, some of just the globally where divestment is happening. As you see, less in the US, we're behind Europe in this realm. And then just a couple of examples of some of the entities that have divested from fossil fuels. So I'm going to say, before I hand it over to Dan, I'm going to say a couple more words just about where we're at with our local PERA campaign, and also just where we're at with divestment work in general. I wanted to mention too, I think it's important for those of you who aren't PERA members, and just per my earlier point about where our money is invested, this issue is definitely, per the debt issue too, it's definitely wrapped up in the banks and the subsidies. And one thing that I want to make sure to mention, because a lot of people don't know, is that banks are playing a huge role in financing fossil fuel projects and just perpetuating the extraction. And as we know, it is getting more expensive, and the amount that banks are investing is actually increasing. So we just have this conundrum right now where we have, we've got the issues with debt. We have banks, for example, and other entities have said that they support the Paris Climate Agreement and are verbally saying, yes, we acknowledge climate change, and yet the money is still in this upward trend to finance fossil fuel projects and invest in fossil fuels. And I'll just give you the example of JP Chase, which there was a climate change report that came out earlier this year. It's called Banking on Climate Change. So if any of you are interested in this, it's a great report. But it just highlights this issue of JP Chase is the #1 bank that invests in fossil fuels. Wells Fargo's #2, Citi is #3, Bank of America's #4, and then followed by a host of other banks. But so who we're banking with is really important too, in terms of like where this money is coming from to fund these projects. And JP Chase is a great example of this problem, because since the Paris Climate Agreement just a couple years ago, JP Chase has increased their fossil fuel investments to $196 billion, like just since the Paris Climate Agreement. And that's when the CEO has said, on one side of his mouth, we support the Paris Climate Agreement, and yet that money amount is going in the other direction. And I think it's not, so it's like that's one example, but I think we're seeing that everywhere, where it's like, okay, I think there's some recognition of the urgency of the crisis, but then similar to your graph about Exxon, but we're just going to keep our production like this, even though we know we have to go in another direction. So I just mentioned this because we have a lot of systems that we need to untangle here, and our money is absolutely at the center of it. So I think I'm really grateful for you, Martin, for pulling this together, and all of you for being here, because I think it's part of the problem that's not often focused on. So I want to just let everybody know, especially PERA members, but there's a lot of information on our Fossil-Free PERA campaign website, which is fossilfreecopera.org. So if you haven't yet seen that, definitely check that out. There's a lot of information. You can sign up to get updates, and so you'll be kept in the loop of what's going on with the campaign. But in terms of where we're at right now with PERA, so it's been a couple of years where PERA members have been calling on the pension fund to address this issue and to please divest from fossil fuels. And we've had people calling, people showing up at town halls, people showing up at board meetings and giving public comment. Last year, we were trying to offer a presentation to the PERA board and the director and the chief investment officer, and they weren't ready to hear from us then. But the good news is this fall, just a few weeks ago, we were able to have that meeting. That it was an hour-plus long meeting with the director and the chief investment officer and about 4 or 5 other staff. And so I feel like there is some progress here in terms of the issue being elevated and the willingness to hear us out. Another thing that is really exciting that you're all going to hear a little bit more about is that the Fossil Free PERA campaign commissioned a study with an organization called Corporate Knights, and they just did an analysis of PERA's fossil fuel holdings, and they did a data retrieval process. They looked at the last 10 years of PERA's holdings, and they showed how much money PERA lost by not divesting sooner. So over the last 10 years, if PERA had taken their money out sooner, they would be between 1.7 and 4.5 billion dollars richer. And I think this is something that a lot of people are still in this mind frame of like, oh, but fossil fuels are so powerful, we can't take our money out, the pension funds will suffer, everyone will suffer, right? But it's actually, it doesn't appear to be true. So I'm going to hand it over to Dan in just a moment, but that study is really exciting. We're actually going to deliver those results to PERA next week, so you're some of the very first people to hear about it. But we're hopeful that this will just keep the pressure on, keep the awareness being raised about the issue, and then we'd like to have legislation actually, because PERA won't make the decision to divest on their own. It has to come through the Colorado General Assembly. So we're hoping to run some legislation this next session, focused primarily on coal and tar sands investments. Yeah.
One quick question.
Yeah.
When you talk about banks, they're part of financial institutions. Are other parts equally bad, like credit unions, savings and loans, or is it just really?
And, I know I bank with elevations and definitely made sure, the money is staying local and no fossil fuel projects. So usually credit unions are great. Thanks for that question. I know we'll have time for more questions in a few minutes, but I'm going to go ahead and hand it over to Dan. And thank you for, thank you. I'll let you do that.
Well, thank you so much for having me this evening. As Deb mentioned, my name is Dan Carreno, and I feel like I have to start by regaining some credibility. So I'm not a banker. I'm absolutely not a banker. I'm the furthest thing from a banker. I actually did work for a Wall Street firm for many years out of New York City, but I think very similar to your story, I found religion and realized that I was essentially part of the problem and not part of the solution. So came and got involved in an organization here in Colorado called Change Finance. And what we do is actually build investment products for everyday people that allows them to divest from fossil fuels and to do things with their money, which is far more responsible, far more sustainable. So I'm going to say it one more time, not a banker. Sorry. And also, if I could, I did want to just real quickly start off by addressing your question, if I could. I was kind of biting my fist over there for a second. So if I understood you correctly, it's, well, if these returns are so poor, why isn't PERA seeing the writing on the wall, and why aren't they just divesting from fossil fuels, right? So in the investment business, there's a term that everybody uses, which is called reversion to the mean, right? So we just assume that the way things have been in the past, even if there's been a deviation to that trend in the short term, it'll eventually revert to that mean. And I believe that there's a huge number of investment professionals whom are very, very smart at the end of the day, but they're just assuming that we're going to see this reversion to the mean. And even though fossil fuels have performed very, very poorly for the last, let's call it 5 years, that sooner or later it's going to catch up. And I think they're fundamentally misunderstanding the market, and we're going to talk about specifically why that is. So before I get there, I did want to just put up a little bit more information about the results of the study that Deb mentioned regarding PERA. So just a graphical representation of the numbers that she mentioned. And what they actually did, just to be a bit more specific, is they looked back over a decade and said, okay, if we did not invest in vertically integrated energy companies and also divested from companies that derive at least 10% of their revenues from the fossil fuel industry. So even a company like GE, which has actually done really, really poorly because of their investments into, basically fossil fuel infrastructure at large. So if you backed all of that out of the portfolio, what does that actually do for the returns? And you can see that it's a pretty significant difference. And just to put some more specific numbers around that, if we looked at the divested fossil fuel portfolio, outperformed over that last decade by 35%. And when we're talking about a very large portfolio like PERA, that really adds up to some very, very big numbers. And dividing that by the total number of PERA members, that's an additional about $3,000 per member had they actually divested and saw the writing on the wall 10 years ago. So that's a meaningful sum of money to all the members within the association. So it's always easy, though, to look back and say this has been the problem. If you had done this, you would have made more money. That's a very common thing that everybody does in the financial industry. To me, the much bigger question is, why should we expect this to change? Why should it not revert to the mean? Why is it going to be different this time? And here is where I see some danger for PERA going forward. They still have about 6.5% of the portfolio invested in these types of companies. That, again, is a very large dollar amount, talking about a portfolio that big. That was as of June of this year. Before we actually, I guess, talk specifically about the dangers moving forward, this is one of the things that I don't think we talk enough about. If we do divest, how does this actually help fight climate change? How does this make the world a better place for your daughter and everybody else in the room? And this is where I just want to talk a minute about corporate incentives and why divestment and the way that all of us invest our money makes a huge difference. So what we're looking at here is basically the growth, more or less, of sustainable, responsible, and impact investments over the last decade and a half or so. And what we have seen is that amount of money has grown quite a bit. So if you are a corporation like ExxonMobil that conducts itself in an irresponsible or unsustainable fashion, you are getting cut off from a portion of the equity market overall, right? There's just a whole big number of investors who are not going to buy your stock. And if you are the CEO of that company, like Rex Tillerson, that's going to affect your compensation, right? Because they're all compensated on stock options and things of that nature. So where we saw is that back in 2010, about 87.8% of the capital markets still available to these fossil fuel companies. So a guy like Rex Tillerson doesn't even really think about it all that much. It's not moving the dial just yet. Fast forward to last year, we're talking about 1 out of every $4 in the United States is invested in a sustainable or responsible fashion. So now all of a sudden, about a quarter of all of the capital markets are being cut off from these companies. And if we extrapolate this trend and this growth rate, which is going up exponentially right now, as soon as 2026, the majority of the capital markets will essentially avoid companies like ExxonMobil and Conoco and all the other ones out there. So this is a really, really strong incentive for corporate managers. They are looking at these numbers, and this is changing the way that they're thinking. It's a little bit more difficult in the fossil fuel industry, but even for a company like Amazon, right, they are seeing the writing on the wall. And that is why you've seen them commit to being totally based on renewable energy. They're buying 100,000 electric delivery vehicles. So this is making real change in terms of how large publicly traded corporations operate. So sometimes we don't talk enough about how these things are actually changing the world for the better. So I just wanted to spend a minute on that. But to go back to the risk aspect, so this idea of stranded assets, which Deb referenced before, just to elaborate on that just a little bit more, and this is a thesis that is already playing out in real time, which says that because of these issues, market forces, climate change, we're going to see a massive devaluation of the fossil fuel sector. So the way that we have done things on Wall Street, right, is we make these assumptions. And we assume that a company like Exxon, who owns these vast reserves of oil and gas deposits that are under the ground, all these Wall Street analysts say, well, eventually they're going to dig that stuff up. They're going to sell it in the future. It's going to create future revenue for them. And then based upon what we think that future revenue is going to be, that kind of determines the stock price, right? So stranded asset thesis basically says, well, what happens if Exxon only digs up and sells 70% of what they own under the ground, or 50%, or 30%? What does the current value of that company look like today if we make that assumption? And I can tell you that the picture gets very ugly very, very quick. And people are coming to this realization. And the most forceful reason that we will probably see that happen are these market forces, and Deb mentioned these numbers before, but I think it's nice to actually look at these from a graphical standpoint. And so essentially what we've seen here, right, I'll start at the top. Coal roughly costs anywhere between $60 to $143 to create a megawatt hour of electricity burning coal. And over the last 15 years or so, we saw this big explosion in fracking, which we saw in sort of the graphs that Dar-Lon had up before. And that created a drop in the cost of natural gas. So all of a sudden it became much less expensive to burn natural gas to create that megawatt hour of electricity. So you essentially saw coal get undercut in the market.
I have a quick question.
Sure.
These figures of levelized cost of energy, do they relate to a new coal plant being built and then fueled, or is it just to run an existing coal or natural gas power plant?
Right, no, that's a great question, and I'm sorry, I just sometimes assume that this terminology is, everybody's out there looking at this stuff all the time. So levelized cost of energy takes into account the entire life cycle of the facility. So it's construction, decommissioning, it is fuel costs during the course of operation, so it's everything. So it's really the best way to think about how much it costs to actually create electricity at the end of the day. So to go back to this undercutting of coal in the market, the result of that in the stock market was this. And that's about as ugly as a stock chart as you will ever see. This is the last decade, and while the S&P 500 returned about 15 some odd % to investors every single year over the last 10 years, it's been a really good decade, coal has been down about 15% every year over that same period. It is literally, I think, the worst thing you could have invested in 10 years ago. I am still trying to find something that would have been worse as an entire industry. So pretty ugly. So that's the result of it. But a lot of people will say, you know, to your point, this reversion to the mean, oh, well, that's coal. Coal is all, you know, London back in the 19th century. You know, it's all natural gas today, and of course, oil. That's never going to happen to the gas or oil industry. Well, you know, we look at that same chart, and you see where natural gas is, and you compare that to the statistics on wind or solar. You know, the same exact trend, the market force that derailed coal 10 years ago is now hitting natural gas. And PERA is still sitting in natural gas investments. And why they are is a mystery to me. So it is once again, I think history is repeating itself. Definition of insanity, do the same thing over and over again, expect a different result. And we are seeing this play out in real time. We have Xcel Energy moving to basically, hopefully, a carbon-free model. They are getting some press out of that, as you see from the Denver Post, and they're trying to position themselves as sort of a green company for it. But the real reason they're doing it is because they're putting contracts out to bid for electricity generation, and the cheapest ones coming back are from the wind and solar guys. So they're like, you know, we're going to end up going to wind and solar anyway. We might as well put out a press release and make ourselves look good in the process. So that's essentially what's going on. Natural gas plants, there was actually a study that was just done by the Rocky Mountain Institute just in the last couple of months, very comprehensive, about $70 billion worth of natural gas stranded assets we're looking at right now, which is going to be very, very damaging to the markets overall. So I'm going to bring it full circle back to Deb's first slide and this idea of fiduciary duty. And everybody believes that, oh, you know, a fiduciary duty means that we just have to be broadly diversified, regardless of what you're actually diversified in. That's really not what fiduciary duty means at the end of the day. It means that you have to do what is in the best interest of the individuals for whom you are stewarding their money. And to essentially ignore all of the data that we've looked at this evening is looking more and more like every single year that is going to be a breach of fiduciary duty. And this is a quote from Bevis Longstreth, who is the former Securities and Exchange Commissioner, saying that it is entirely plausible, even predictable, that continuing to hold equities in fossil fuel companies will be ruled negligence. That's a pretty firm statement from a guy who used to run the SEC. So with those comments, I'll wrap up. I see that I've got a question already, so.
Yeah, so we weren't able to give a whole presentation like this, but I actually did bring a copy of presentations that Dan and I had actually offered to some labor unions who are PERA members. So they did have copies of other presentations that had a lot of this data in it. So we printed out several and made sure that they had them. So yes, I'd say actually most of this content was in that presentation that we offered. Yeah. So they did get it from us. Yeah.
And I do believe, my heart of hearts, that they are starting to see this writing on the wall. But in the financial industry, inertia, again, is just a very powerful force. And you have investment committees and a lot of different decision makers. So that inertia is really preventing the type of swift action I think we would like to see. But I think that this type of data is really changing minds and making these professionals look at the market a little bit differently. So, sorry.
The CEO of Shell Oil was just questioned about significant increases in oil projects. And he said that we have no choice to go ahead in that direction. And I'm sure he knows all of the data that we've seen in this room. And it makes you wonder why there isn't a really significant turn toward renewables, or I think maybe the heart of it is some regulatory treatment for the stranded assets. So there's an incentive to leave them in the ground and lead them out for future generations. There's ways to get them out of the mousetrap, I think.
Yeah, so this is not a totally comprehensive answer. This is not the only problem, but a big, big problem is that corporate CEOs, like the gentleman from Shell, are not really making decisions about what is going to happen 3, 5, and 10 years down the road. They are making decisions on what is happening 3 months down the road, because we have created a situation in the United States where public companies have to report earnings every 3 months. And if you start making decisions that in the short term may cause pain and a lack of profit for that company, even though, like investing in renewable energy, in the long term that is obviously the best thing to do, you essentially get crucified in the short term for making those decisions. Hence, we have all the wrong incentive structures in place for our corporate managers. And that is where, to go back to my one graph before, the more money that gets invested into sustainable, responsible, and impact investment strategies, the more that it gives some breathing room to these corporate CEOs to say, actually, if I don't make these changes in the short term, that's going to be more painful than if I did make them. So I think this is one way that we can address that issue. The other way, of course, would be to pass different legislation and have companies report earnings on an annual basis, but that's just frankly not going to happen. So sorry, that's a bit of a diatribe on my part. As you can tell, I've been angry about this for a while.
Sorry, I was just noticing the declines in returns for coal industry. It's kind of leveled off in 2016 on the graph.
Yeah, was it this chart you were talking about?
Yeah.
Yep.
How much of this is driven by regulatory government decisions?
I would say very, very little of it. This has been mostly market forces. And again, I'm just going to use Excel as an example, right? They put contracts out to bid, right? The population of Denver is increased by X percent. We need Y percent more in terms of megawatt hours of electricity. How do we generate that? And they, auction, right? Who can create that electricity for us the cheapest? And It started back in 2010, and the coal guys could no longer, of course, or I should say it actually started before then, but those were no longer the least expensive energy sources anymore. And then the market is a very, very powerful discounting mechanism at the end of the day. So as soon as these types of bids started to come in on a lot of these contracts, the market said, it's unlikely that that trend is going to reverse. It's unlikely that coal is going to become less expensive than natural gas anytime in the immediate future. So the assets just go on fire sale, and that's why you see that complete collapse back around 2012.
Also, if there are questions for Dar-Lon, then...
I guess I would like to think, and I am pretty confident, that a company like ExxonMobil, which has thousands of employees, I assume that many of these individuals are very good people who have children that they love at the end of the day, and many of them must see the same information that you are seeing. So how do so many of those people continue to sort of do that work and not come to the same conclusion that you did?
Absolutely. When I first started with the company, I was recruited on the premise that we're an energy company and we'll do whatever energy makes sense. And that changed when oil prices skyrocketed. And suddenly we became an oil and gas company. And we weren't supposed to recruit people saying that we were an energy company. We were supposed to say that we were oil and gas. And a big reason was because we bought XTO, which was an unconventional hydraulic fracturing gas company. And since we spent so much money on it, and Rex Tillerson put so much of his reputation in it, he had to double down on oil and gas. And since we were making a lot of money at the time at the high oil prices, nobody was going to question that. The problem was that after oil prices dropped, we continued to double down. We have a performance ranking system where you're punished if you don't help people that are above you. The people above you hear messages that are against what they're pushing. They're not going to rank you very highly. And so even though there are lots of people, especially in the research company, who spent a lot of years in graduate school, were not in the oil and gas industry before they joined the company, even though they can see the writing on the wall, they didn't feel the ability to speak out about it and to influence any business decisions about it. And in fact, a couple of weeks before I left, there was a public employee forum with our presidents. And I stood up and I said, why are we actually trying to increase our oil production when scientists are saying that we got to reduce our emissions in half within 10 years? And nobody supported me on that. And I didn't get a good answer from the presidents either. But after the meeting, some people came up to talk with me and say that, yeah, they agree with me. They just don't want to speak out in public about it.
Well, when it's your your job's on the line, and yeah.
That's interesting, the performance metrics that you were mentioning and just the internal corporate culture seems damaging for what needs to happen.
I think it's a tricky balance. I have a sister who's an officer in an oil and gas company, and they do a lot of fracking. And she would claim that if they were to stop doing what they're doing, along with other oil companies, the world would be in a big hurt. And so we want renewables, but it's not going to happen overnight. And they would say in their defense that we would probably do more harm to millions of people, billions of people, if we ceased bringing oil out of the ground. And so I think you really have to see how fast renewables can come online. And of course, it can be affected by governmental subsidies and all sorts of things. But nevertheless, we still are consuming an enormous amount of energy. And renewables is a tiny, tiny sliver. And until it's going to be, it has to, double, triple, and quadruple, every year for many years before it can be a viable replacement for the fossil.
Yeah, and I know, I see 3 hands, and I just wanted to say just really quickly, I know from us at 350 Colorado, that's why our key asks are a transition plan that needs to start right now. And I think that's the thing, is that rather than creating the transition plans, entities like Exxon or banks or institutions are maintaining that status quo or doing more studies and analyses, kind of like putting off the plan. Because yes, it will take years to make the transition, but we have to start right now to plan it, and we need the legislative support and the regulatory support and all kinds of layers of support. So I think I just wanted to say that for me, in my work, it's about pushing that transition as soon as possible. And Marie, okay, let's do 1, 2, 3. Does that sound good?
Dan and I are also members of Good Business Colorado, and I wanted to try to answer this gentleman's question. I think it's so so important for us to be careful and not fall into the arguments of these industries, because Boulder, for example, went out to the market to find out how fast they could actually make the transition, what the market is capable of. And they found they could get to 89% renewable energy by 2024 at just 2/3 the cost of Excel. So it's very possible. A lot of folks like me, who, I did cost-benefit analysis professionally, thought that, well, when it becomes profitable, these switches will start to happen. But the problem is it's slightly more profitable sometimes for them to operate their old, their old infrastructure longer, to our detriment and the detriment of our kids. There was a recent comment made to Excel in Minnesota by the Institute for Local Self-Reliance, and they noted, and what I'm passing out right now is Excel right now wants to spend hundreds of millions of dollars on gas and coal and to upgrade their facilities that are just going to be stranded. And ILSR, Institute for Local Self-Reliance, noted that these investments are profitable for the Wall Street investors right away, but they, are typically not going to benefit the ratepayers according to their models until 20 years in the future. And I think most of us in this room know that they won't be operating 20 years in the future. So it's yet another scam for basically Wall Street over the rest of us. And this isn't even beginning to address the air quality health effects or the climate change risks. So it's really a gigantic problem. And everybody, please show up on November 6th. It's 4 to 6 p.m. at the Public Utility Commission. Good if you can get there by 3:30. And if you would like to get some background information ahead of time, you can come to the UU in Boulder on Saturday from 1 to 5, and hear Leslie Blestrom and other people, or just catch Leslie on October 30th at 6 p.m. at Stanley Lake Library, and that's all. Here, I'll pass out.
Great, thank you. So let's review.
There's somebody in the back who was first, so.
Oh. Okay, sorry, go ahead.
That's okay. Yeah, so I'll just introduce myself. I work for a local solar company, and I came here tonight. I don't have any pension plans or anything like that, but I'm always, trying to learn more about, investment and how this affects people, in the immediate and down the road. And, I don't really have a question, but more of a comment. I'm curious to hear your comments on it. Is, you left Exxon earlier this year, correct, in 2019? Yes. So I've been following, just some news articles, and I actually read that Exxon and Shell are both starting investments in the solar industry, maybe possibly in wind as well. But so it seems to me like, you know, the winds are changing already in this favor among the large corporations. But you know, the big takeaway for me from all of this is that, you know, there's, you know, what we can do to support that change at the large scale, but also at the local level. You know, what can each of us do to support that, whether it's, you know, investing in elevations, who I also use, or, you know, investing in local solar companies, or, you know, solar farms, whatever that is. So anyways, that was kind of my comment, and curious to hear your thoughts on those transitions.
Yeah, well,
Please go ahead.
with regards to ExxonMobil, there has been a biofuels research project, and hundreds of millions have been invested in that. The reason for the biofuels is because ExxonMobil feels that's closest to their business, that it could be used in refineries. The problem, though, is that when you're using algae to collect solar power, you're competing with the efficiency of photovoltaics to collect that same power and run electric cars, rather than making biofuels off of algae that's lower efficiency.
If I could too, I would say that if you look at the percentage of assets that a company like ExxonMobil is investing in renewables or alternative fuels like biofuels versus the amount of money that is going into traditional drilling activities, you know, it's a rounding error. And the activity that they're doing right now, financially speaking, I'd say is appropriate for like 1982. And the problem is that they've kind of strung us along for decades, and they've said, oh, you know, we are investing in this stuff over here. You know, we're putting $100 million, which to them, again, is not a lot of money, and they've just continued to pump all this other money into not only drilling activities, but of course misinformation campaigns at the same time. So there has been a big contingent in the financial industry that has said historically that, oh, you know what, it's actually better to invest in these companies and to have a seat at the table, be able to vote on shareholder resolutions and try to steer them in the right direction. And we've been trying that for 30 years and have essentially gotten nowhere. So at this point, I think most of the industry that looks at the world in a similar way that I do has said, you know, there's just really no other option aside from divestment.
We don't really have the infrastructure we need to have. And it's a huge problem to rebuild basically our entire economies to run on renewables and to replace a lot of the infrastructure that we have. And we only have a short time to do it in. And the paradox is that we need fossil fuels to power those earth movers and to produce the steel and produce the concrete for the infrastructure we need to have. And I'm not sure how you can overcome this inertia problem, because there's, you know, like hundreds of coal plants sitting in China that are just brand new. And they're building more of them. And they're going to be they plan to use coal, and those assets will be stranded. So, I mean, we've got to change the way our infrastructure is, how we think about doing things, so that we can move quickly to some other infrastructure.
Thank you.
So I'm not sure, how do I make that into a question?
Well, I mean, I think we would all agree, and I think that's the largest question of our time, and how are we going to do that? We need to start working on it right now. But I think, to Marie's point, you know, in Boulder, in a place like Boulder that is thinking in this direction,
yeah,
we did find, the study that they did find, and the request for proposals found that they could make this transition feasibly and financially by 2024. Mm-hmm. So, and not only that, you know, I heard the chief sustainability officer give a presentation on this. It wasn't just like 10, you know, companies showed up. It was like hundreds from around the world, ready, like stacked up, ready to go to do this. And I think the same thing with Xcel Energy. My understanding is that Xcel Energy is leaving over 90% of renewable energy bids on the table. This past year, it was over 90% of them are left on the table. Why is that? Again, like, I think that the technology is there, the will is there, at least in a subsector of the society, but there are political forces and other forces that we have to overcome in order to get to this place. I also, just one other example, and it has to do with the summit that Marie mentioned. So on Saturday in Boulder, 350 Colorado is hosting a renewable energy summit with a focus on moving beyond fracked natural gas. Because in our fracking work, we often get this question, well, we're heating and cooling our homes with natural gas. What are we going to do? Well, guess what? There is all kinds of alternative available technology right now in our state that could replace the natural gas. But we have politics that are getting in the way. So even right now, there's, and there is legislation that will be coming in 2020 that is going to be promoting this heating and cooling, these alternative heating and cooling solutions. But because natural gas is still so powerful in the state and the forces behind natural gas are so powerful, it's kind of like holding us in this pattern. But really, the technology is there, and the people are there willing to implement it. We just have some barriers to get through to get to that.
I think the technology is there, but now Boulder is a small place. I want to save Houston.
Right, yeah.
And that's
yeah.
big. How do you?
I think the same thing. There would be hundreds of companies around the world ready to come and do that.
Well, Houston should be doing this job, actually. They should become the suppliers of.
Yeah, and I'm sorry, I don't know if either of you wanted to add anything to that too.
Yeah, so I mean, this is getting into the weeds a little bit, but the, financially, I guess the problem that I would say is that we are currently not operating under what is known as full cost accounting, right? So there's very, very, very expensive environmental and social externalities that are being created by these companies. And we, as a population, absorb those costs, right? Each one of us shoulders, $1 a month or whatever the statistic is from the latest study. And I believe that if we just went to a full cost accounting model on this, all the things that seem so impossible for us to do, the economy is actually a really efficient mechanism, and it can do pretty amazing things pretty quickly. I actually believe that we would be able to achieve these things pretty quickly. I mean, this is like a really short anecdote, but
I think that's a very good answer.
yeah, so I mean, this is just something to keep in perspective. So back in mid-1800s, Napoleon Bonaparte, right, is marching across Europe. You guys are thinking, where is he going with this, right? But he was holding these very lavish state dinners at the time, and they would have different levels of plates and cutlery for the different kind of socioeconomic status that would come in. Silver was at kind of the bottom of that status. Gold was next, and then does anybody know what the most expensive, most valuable metal was at that period of time? Aluminum, right? So, and we at that point in time just did not have the right technology, the right incentives in place to create a lot of aluminum. Fast forward about 20 years or so, the world went from, as an entire species, we went from creating a few hundred pounds of aluminum every year to millions of tons of it. Right? So the economy can be really, really effective in making extremely drastic changes in a very, very short period of time. I think we can really surprise ourselves, but you need the right incentives in place in order for the economy to do what it can do well.
And just to address your
Sorry, that was a little bit of a tangent.
yeah.
But
Just to address your question about Houston, I had an hour and a half commute. It used to be 40 minutes because we had a location that was centralized in Houston, but they moved it to the northwest part. So all the folks that live in the south had the commute double. We weren't allowed to work from home. So if Houston just allowed people to work from home, that would make a tremendous difference. And also if Houston started adopting practices and technologies like what we're doing in our sustainable community GEOs. You start locally with neighborhoods using geothermal heat pumps, and then you don't need to use too much natural gas. And the heat pumps can also help you during the summer. You don't need to use as much air conditioning. You just start locally and then gradually you can work yourself up.
Okay, I think we'll have one final
I think these
question.
two have both been waiting, so maybe they can do those
different things.
really quickly and then.
Yeah, okay.
A couple of things. One is that we do have the technology now. We do not have the will. Everyone in this room should be net zero, absolutely. We've got the technology, the price is coming down, we could do it. Change always starts from the bottom up. The other thing in terms of fiduciary responsibility, with all due respect to your sister, when I hear that that's very myopic because the world is dying around her, and the gas companies think that they will save us all from this, and they won't. They're the problem, but they're the ones who say, if we change, if we go to this, if we go to that, the whole industry will fall apart. It probably will at some time when we will have to absorb the change, but we can't keep thinking our way as the world around us dies, and all the people who are drowning and being kicked off their land, and how dare they say, we're in charge of this and we're gonna save the world. They won't. You made me mad.
And I totally agree with Linda's point of we can all be net zero now. She is, John is, I am, Ron and Gretchen are, and this is not in brand new houses.
And all you people in geos.
In all people in geos. So we can, but the point that I wanted to make separate from that is, we've been talking about a trade-off here. Trade-off between fossil fuel and a transition to renewable. The discussion has not clearly enunciated that it is the megawatt that facilitates accelerating that. The megawatt is stopping using, i.e. being efficient, i.e. thickening walls, going to daylighting, doing all the things that make it so you don't need the energy. So if the demand shrinks, the fossil fuels can shrink and renewables don't have to grow so far. So we got to imagine a world with less energy greed and more energy smart.